yield to, pardon me, for my chairperson, and I will now yield to the ranking member of the subcommittee.
Well, thank you, Chairman Green. And I want to start by acknowledging our subcommittee chairman, Al Green, for convening this hearing. Thank you, Chairman, and especially for all your efforts over the course of your congressional career in working to combat discrimination, race discrimination, which is to be commended. And I'm pleased to participate in this hearing and welcome all of our witnesses. All of your work and efforts are a great value to our committee, and we thank you for being here today. Obviously, race discrimination is abhorrent, and it should not be tolerated in auto lending or the insurance industries or any industry. There is anecdotal evidence of auto lenders charging different rates based on a borrower's race. So we're here today to understand how the industry has changed, how it prices risk without discriminating on the basis of race, and what needs to be done to make sure that everyone is treated fairly regardless of race. This committee has spent considerable time examining discrimination in auto lending, and we take this issue very seriously. The committee has investigated and released several reports on this matter in the past, and our work is ongoing. Studies purporting to show widespread discrimination in auto lending have routinely proven flawed. For example, a 2013 report by the CFPB contended that dealer-assisted auto financing has a, quote, disparate impact on the price of credit for consumers in protected classes. As it turned out, the CFPB's methodology for counting African Americans was off by 41%, among many other problems. The committee's investigation of the matter found that the CFPB knew its methods were deeply flawed and prone to significant error, according to internal documents, but the Bureau released its study anyway. To be clear, racial discrimination in auto lending is illegal, and it should be. We must ensure that the industry does not move backwards, and we need to base that work on accurate data and reliable findings. States continue to be the most effective regulators of the auto lending industry, as has been the case for almost a century. This was certainly true in 2010 when Dodd-Frank was enacted. Section 1029 of the Dodd-Frank Act specifically excluded auto dealers from the CFPB's jurisdiction. It was obvious then, as it is now, that states were best positioned to ensure consumers are protected. We'll also examine the auto insurance industry. The United States has the largest and most competitive market for auto insurance in the world. Like auto lending, the auto insurance industry is regulated at the state level. In fact, these are two of the most heavily regulated industries in the entire financial services portfolio. The price for auto insurance varies throughout the country, depending on a litany of variables. The competitive nature of this industry has led to more affordable prices for consumers. As with so many other things, the key to lower prices is free markets. We need to look no further than Illinois to understand why. In Illinois, an inadvertent lapse in regulations allowed a flood of insurance companies to enter the market. That competition drove down prices for consumers, and the Illinois legislature chose not to enact new rate regulations. It is not just competition that affects the price of insurance. State laws greatly affect prices as well. In 2019, Michigan was ranked as the state with the highest insurance premiums. The high prices in Michigan reflect decisions by the state legislature and the insurance commissioner. Michigan's no-fault insurance law provides for potentially unlimited lifetime medical assistance for people involved in accidents, and this law leads to abuse of the legal system and fraud. Insurance experts have drawn a direct correlation between the no-fault insurance laws and Michigan's high rates. Unlawful discrimination in setting insurance rates is inexcusable, and it is already prohibited at the federal and state level. In addition, industry standards forbid the use of certain factors such as race when determining rates. Those in the industry have worked to create a system where the insurance credit ratings are purposefully blind to the race of an applicant. I look forward to working with the chairman to ensure that discrimination does not occur in auto lending or insurance, but I also do not want to eliminate risk-based pricing in a way that could increase premiums for most drivers. Thank you, and I yield back.
Thank you. And